Alright, so what's up guys? So for the next a couple of minutes, I'm going to be showing you on how you can actually turn that $100 to 1,000 trading forex. Now, firstly, why should you listen to me? Well, I have done this for about 5 years now and I've flipped multiple accounts, but more to that, I have taught thousands of students on how to do the same. So honestly, I am the very best person to talk to you. Now, I want you guys to pay close attention, take notes, and understand each and everything that I'm going to be sharing with you, okay? Now, the very first thing that you must consider is your trading broker. Now, as a trader, you need a broker, right? So a broker is going to be the intermediate, and I'll give you an example of here. So say we have you as the trader, and then linking you to the financial markets, okay? In here we have the broker. You guys understand? Now, this is very important. Now, I know you should be wondering why. Now, first things first, brokers charge fees. Now, when you're trading off with $100, obviously you need to have the very best broker with a few, tight spreads. We shall talk about that in some other video. But most importantly, faster execution and honestly the very best trading conditions. And with this, I would say it's a bit detailed, but I wouldn't go too much into that. But for you to trade with the very best broker, I just did put the link down in the description. It's a broker that I've personally been using for a very long time now, and it's trustable, and I would prefer you guys using that. So the link will just be down in the description. Now, the next thing that we must consider importantly is the leverage. So I'll just go ahead and take off everything. So we shall talk about that. Wow, it's taking too long. Okay, so the leverage. So the leverage is much more of borrowed capital from the broker. And I'll give you an example. So say you're trading off with $100, okay? And in between here you have the leverage, okay? Now, after that, you will have your total trading, okay? It can be your total trading capital, just as that. And I'll give you an example. So say you're trading off with $100 and you're using a leverage of 1 to 100, okay? So what happens is you are going to get your trading capital times the leverage, and now you'll have a total trading volume or buying or selling power of $1,000. You guys understand? So you can notice that the bigger the leverage, then the more your capital is going to become. But take note, the bigger the leverage, the bigger the risk. And let me give you even much better examples of here. Wow, this thing really takes... Oh. All right, perfect. So a much better example is, I think I'll use a much realistic example. So say we have this illustration of here. And this other side, we have your capital, which is $100, okay? And then this other side, we have whatever is going to be on. Now, let's assume you used a leverage of 1 to 500. So that means your trading capital is now going to be 100 times the 500. I'll label this as your leverage, okay? So it's going to be 100 times this, and that means you'll have a total trading capital of 5,000. Now that means when you're trading off with a small account, say $100, honestly, you may not be able to open up bigger positions or even trade other pairs, by the way, like gold and stuff. I'll show you that in a minute. But when you have a slightly bigger leverage, then you can be able to do that. But take note, the bigger the leverage, okay, the bigger the leverage, then the bigger the risk, okay? So personally, I wouldn't recommend that you go above, say, 1 to 1,000. I know this is ridiculous. Actually, for some brokers, they will even stop at, say, 1 to 500 or 1 to 200. But all in all, as long as you know how to use this to your advantage, then we are all good. And just as how I mentioned, that's how it applies. So for $100, you could even go as say 1 to 500 or 1 to 1,000, and that means you'll be able to open up bigger positions, okay? So that's it. Again, as I mentioned, the leverage comes from the broker, so it's very, very important that you use the very right broker. That's important. No negotiation, no nothing. Now, next up is going to be the pairs that you trade, okay? Now, for a small trading account, you must really, really be so strict, okay? And let me show you something. Okay. Now, the trading pairs. Now, obviously, you're going to trade and you need to make money. And let's talk about those pairs to trade. Now, firstly, I would recommend that you stay away from some pairs. That's going to be some instruments as gold, US oil, and other instruments as NASDAQ. Is that, let's just write it as NAS 100. And more others. Then on the other side, you can put much of your focus. Now, pairs that I would recommend you trade can be GBP JPY. You can also look at GBP USD. You can also trade other pairs as Euro JPY. Actually, these two are even good. Smaller moves, bigger money as compared to GBP USD. Then you can also look at, say, USD JPY, EU. They're also good pairs, but these are even better. So why are we staying away from these? Well, these ones are much more volatile. And that means you could make a lot of money, but on the other side, probably blow your account in a few trades or something. So you can stay strict to this. Or even on the extreme, you could decide and say, I'll personally focus on 1, 2. And that's it, specifically. But honestly, this is an option. Personally, I trade GJ when I'm trying to grow an account or flip or stuff. I focus much more on GJ and Euro JPY specifically. But it's up to you. Off here, you can choose what exactly to put your focus on. And that brings us to the very, very next one. Now, trading sessions. That's also important. I mean, you're not going to come and trade late night and think of making money. So your trading sessions. Okay, so the trading sessions for this, we shall focus on the London session, okay, and the New York session. Oh, it's actually too hot here. I'm sweating crazy. So London session and New York session are actually the most traded sessions in the whole world. And that means you have a lot of volatility and much easier to make money. I mean, I don't want us to be in a trade and we have a whole ton of consolidation, nothing is happening specifically. We need to have bigger moves. Specifically for the London break, that being 10 a.m. East African time or 8 a.m. London time. I think it does change with the seasons, but that's actually the very, very best time to trade. You need to put much more focus on these sessions. So take out, you're not going to be trading the Asian session and then the Australian session. No, we are not doing that for this purpose, okay? Now, we now know the pairs to trade, we also know the sessions to trade, and we have also understood the broker and the leverage. That brings us to the very next part of our whole game plan, okay? Okay, and that's your trading plan. And in there we shall talk about risk management and then compounding, okay? Okay. All right. Oh, by the way, if I could share something quickly with you. So I do run an academy of about 1,000 students, and that's why I started off earlier on that I literally have one of the very best trading academies, and you could also become part of that. I mean, it's just a very low cost that you invest in, but you know that at the end of the day, you're going to make a lot of money back in return. So honestly, I always look at it as nothing to lose, but way too much to gain. So if you'd love to join the academy, you just go over to www or just go forexbullsacademy.com. Pretty easy, and I'll get you access. So now let's talk about risk management and compounding. So risk management and compounding, okay? Now, this is going to be key. This is going to be so important, because if you're not doing risk management, then you're gambling and you'll probably lose all the money. Let me sip some water quickly here. And all right, so as I mentioned, if you're not managing your risk as a trader, more often enough, you are just gambling. And honestly, it's not going to be all good. Now, firstly, what lot sizes are we going to stay at? So, for $100, we shall use 0.01 lots, 0.02, and to the extreme, 0.03. Just keep it in there. Don't go bigger than this. Because I don't want us to open up bigger lots and you're probably losing your whole account because you're trying to flip it or grow that account. Doesn't make any sense, okay? So I shall keep it as low as this. And then more to that, actually, interesting part is, so when you're using this with pairs as GJ or EuroJPY, trust me, that's going to be big money. That's going to be big money. So we shall keep our lot sizes off here. Remember, this is very, very important with your risk management plan. If at any point you're not following this, then you're not going to reach your goals with the flipping or growing an account, all that, okay? And now that brings us to compounding, okay? So we have what we call risk to reward, okay, in trading. And that means you're risking some money to make some money back in return. You guys understand? So an example would be, say you're risking 1 to make 2, okay? So we could easily say 1 to 2 RR, meaning 1 to 2 risk to reward, okay? So that means you're basically risking 1, it could be say $1 to make 2, or you're risking $100 to make 200. This is just an example. Or say a 1 to 3. Say we have a 1 to 3 risk to reward. And that means you're risking 1 to make 3. A clear example here would be, say you're risking $5 to make $15. You guys understand? So this is a system that must be stayed consistent too. Okay? And I'll give you an example. So we all understand, I believe at this point, that you guys know we have losses in trading. No, nothing. There is nothing as 100% winning rate or something. At some point, you're going to take losses. Now, let's talk about that. So, oh, it's taking longer. All right. Now, let's talk about that and see. So, let's assume you take a sample of 10 trades, okay? You take 10 trades, right? Say in a week or something. And then you have 5 wins, okay? And 5 losses. And that means in such a scenario, you have a 50% win rate, okay? You're winning 5, losing 10. Now, let's assume you used a 1 to risk to, actually, to the extreme, let's say 1 to 2, okay? Risk to reward. So that means whenever you are making money, you are making 2R, but when you are losing 1R. Honestly, pretty easy. So here you have 5R, and that's 5 losses, and then off here you have 10R. Okay, 10 rewards. Honestly, at the end of the day, it's the 10 minus 5, and you have made 5R. You guys understand? Pretty easy. Now, if you could put this in as an example of, say, pips or anything. Now, say, whenever you are making money, or your target or your profit, now let's use money. I think that's much better and easily understandable. So we shall put it in figures and see how easy it is. Now, let's assume when you are risking $5. No, sorry, this is the reward side, okay, the win side. So say when you are winning, you are winning $10, okay. But then when you are risking $5. I mean, when you're opening up a trade, you have an option. You have a stop loss and a take profit. So your stop loss is going to show how much money are you risking for this particular trade. Say I'm risking $5 to make how much? Say 10 or 15. Same thing, five wins times the 10, you have made $50 off that account. On the other side, 5 losses times your $5. So that's specifically, how much is that? So it's the 5 times this, about 25, okay? So that means you had a loss of 25 and then a profit of 50. At the end of the week, you are still profitable. You guys understand? Now, this is totally different from someone who makes $100 in one trade, and then out of the blue, in the next trade, when they take a loss, they lose 80. Get the hell out of here. This doesn't make any sense. You're probably going to blow the account in 1 or 2 trades and you're out. But if you're looking at staying in the long run, then you're going to follow this system. And that brings us to the very next thing, and that's compounding. So what's compounding? Well, this is specifically every time you're making money, you are adding money to your account. Now, personally, I'm against this because I assume we are into trading to make money and not honestly please the brokers or prove that we are good traders. That's why I say when you make money, withdraw the money. Easy. Now, in this particular example, say you're trying to grow this. Same thing on the other side, I'll still insist, I mean, the $1,000 could be in your bank account and not specifically on your account. I'll give you an example. A couple of weeks ago, I was trading an account of about, I think, 100. Yeah, I took it up to 1,000, crazy, in about a week. But I was making $100, withdraw the money, take it into my bank account or stuff. And I did that specifically for this example. So when you're looking at making the money, I wouldn't recommend you keep the money to the account. And I'll tell you why. So let's talk about the compounding part of it first. So with compounding, whenever you make money, your account is growing. And I'll show you how I personally do things a bit differently. So let's go back and use the same example. Can I pour water here? I think it would be much more easier. Hope it works. All right, so there we go. Now, with the compounding part of it, so say you started off with $100 and you made, say, 10, okay? Now, this is now your profit, and that means your total capital now is 110. Now, personally, I will always insist on withdraw some of your profit, okay? So if it's the 10, please withdraw 5. I'm giving an example. Okay, withdraw 5, and that's 50% of your profit, and then leave the 5% to stay on the account. Because fine, you're looking at compounding, you're looking at making that 1,000, but what does it help? Say you're up at $600, and out of the blue, the account again goes back to like 0. Because I've seen this happen, and honestly, in trading it does. So at the end of the day, this doesn't work. But what works is you have made the money, withdraw a portion of the profit, put it into your bank account, have it in your wallet. I mean, because you're trading. And then on the other side, bring this back in, okay? And then most importantly, some other thing that I didn't mention is have a time target to it, okay? So you could be, say, a month, 2 months or something, and then follow the whole plan, okay? So this is just a breakdown of how I grow accounts from the lowest, say, $100 to 1,000. But I do have a detailed system inside my academy, just as I mentioned at the start of the video. We actually do this more often, and you could also become part of this exclusive community. So again, what you shall do is go over to Forex Bulls Academy, okay? Forex Bulls Academy.com, okay? And in there, it's currently at $147, but we are raising the price. So for the fact that you watched the video up to this point, you should actually be in, and I'll see you inside. So with that, I'll see you in the next video. Cheers and let's go. Remember, when you're in, there's never looking back.